My name is Shane Dunn. I'm Senior Director of Development and Alumni Relations at Brandeis International Business School. We're really glad to have you with us today. First off, and importantly, again, really glad to have you with us today, even if you likely have other important things on your mind or concerns about friends, family, colleagues, and neighbors. Our thoughts are certainly with everyone, including here in the United States, as we face a range of challenges and unrest regarding racial justice, and then, of course, around the world with this current global pandemic. We're really glad we're able to move forward with this discussion today. We think it's timely and relevant on a number of levels. We do remain in the middle of a pandemic here in the United States, and we have seen how the economy has been significantly affected. Small businesses have been especially hard hit, and we are fortunate enough today to have two experts from Brandeis speak to us about how COVID-19 has affected small businesses. Before we get started, just a couple of quick housekeeping items. This is a webinar for folks who want to ask a question later on. I will queue up questions, but the best function to use here is the Q&A function, which you should see at the bottom of your screen. We do ask, we're not going to do a poll of this session, which we've done in previous events, but we would love to know where folks are today. So if you can use the chat function just to briefly say hello to us and let us know where your city, state, country that you are at today, that would be really helpful to all of us, especially as we are a global business school and global university. So if you have a question, thank you. We're excited to engage with you, but it'll be best later on, which I will queue up around 12:40 or 12:45. We'll see how things go along. In the meantime, I'm gonna turn it over now. First, we have Professor Debarshi Nandy, who's a professor of finance and the Rosenberg Chair and co-director of the Rosenberg Institute for Global Finance at Brandeis International Business School. And he's going to engage in conversation with Barbara Clarke, an early graduate of our pioneering program at the business school, the Lemberg program. Barbara's a graduate of the class of 1991 with an MA in International Economics and Finance, and has had a tremendous career, and most recently on the investment side, and has done a lot of work investing in minority-owned and led businesses, as well as a range of other experiences that she has to bring to this topic. So without further ado, I am going to turn this over to Debarshi to kick things off. Debarshi?
Thank you, Shane, and welcome everybody. It's a great pleasure to be here with Barbara today. Barbara, welcome, and thank you for joining us in this discussion. So we will be, speaking in general about the impact of COVID-19 with particular reference to small businesses and high growth startups. So just to set the tone for that, a little bit of this we are going to separate between what we refer to as high growth startups, which are typically what are funded by venture capitalists, angel investors, versus small businesses, which comprise the majority of businesses in the US, a lot of which are actually minority owned, particularly in the industries that are heavily impacted by COVID-19. So welcome everybody, and to start off, Barbara, what do you think the overall situation is at this point in time?
Well, I guess the first thing I just want to say is, yeah, it's a total shit show, right? So this is setting the tone for our conversation. We'll be frank and just acknowledge what a mess everything really, really is, and especially combining with the pandemic, and now all of the protests. And then, and of course, then we have what I see as an organized crime element happening under the cover, hiding behind these peaceful protesters. So yeah, it's a very big challenge for businesses. So yeah, how should we pick this apart today? I've been doing as I was going to say. So in my background, I'm a traditional venture capitalist. I'm also an angel investor, and then I have other kinds of private equity investments that I do, especially in areas around revenue-based financing. And then as a community member, I live in Boston in the South End, which is populated by lots of small businesses. I've also been focusing a lot on what are the needs, and particularly the capital needs of small businesses, that are sort of like the main street. And I'm sure we'll get to this topic
Absolutely.
too, but I feel like everything is sort of like a small business when it's maybe perhaps not. So anyways.
So thank you, Barbara. So, perhaps we could start off with me sharing some of the data that I kind of put together. Let me share my screen quickly with you, and then we could go into a discussion, Barbara, with on some of these issues that are affecting our community today. So I hope that everybody can see the screen right now. There are obviously a huge amount of effort that has been taken by the government as well to combat COVID-19, and particularly to address issues that have also affected small businesses. And in the last series of this webinar, Professor Cicchetti talked about all the monetary policy measures that have been taken by the Federal Reserve, which I sort of borrowed some of this from his earlier discussion. Two of these things which are of particular relevance today to our discussion are the last 2 points, which are the Main Street loan programs and the Paycheck Protection Program, and also the recent enhancement to the Paycheck Protection Program that was passed a week earlier by Congress. Most of all of you probably know how this works, but essentially these are two different programs. This is mostly a loan program, and there are 3 different ways in which these loans are made to small businesses. These are targeted towards small and medium-sized businesses up to 15,000 workers, which is quite large actually. And these are loans. These are not forgivable loans under this program. And then, as opposed to this, there is the PPP, and then the PPP Flexibility Act, which essentially extends the PPP dollars. These are more targeted towards small businesses, where and the whole idea behind these loans is to provide support towards extending the payroll and employee benefits. And if these businesses can, meet certain criteria, for example, if they spend 75% of the PPP towards payroll, maintaining payroll and employment, then these loans would be forgiven by the government. So these are mostly the 2 different main support programs, totaling about $1.2 trillion actually, that have been enacted. And so jumping into the PPP.
Oh my God! Look at that chart.
So this is a chart from the U.S. Census Bureau, actually, which they have a big, what they have done tremendously is keep a pulse on small businesses and look at where businesses are applying for these loans. If you look on the vertical axis, that is applications, and on the horizontal axis is how they have been impacted by COVID-19, so revenue losses. So if you are in this top right quadrant, you've been heavily impacted, and for example, New York, heavily impacted, and also a lot of people there have applied for assistance. Whereas if you look down here, New Orleans, Providence, Miami, heavily impacted, but PPP applications haven't really been that high. And on the other hand, not so heavily impacted, but high PPP applications. And you can see that there is a lot of heterogeneity here. Similarly, this kind of spills over. So this is the small business pulse data as well. This is current as of May 23rd, and looks at how the country has been affected. And you can see from this, the overall impact is all across the country. Darker shades of blue mean higher impact. This is the same thing across different industries, the national average being 45% of firms, small businesses have have been impacted dramatically, of which certain sectors such as accommodation, food services, this is social health impact, this is education, all of these have been impacted dramatically. So why don't I stop here and hand it over to you, Barbara. What would be, if you have any thoughts on any of these?
Well, we can keep up your beautiful slides if you wanted to, but I think there's a couple of important distinctions. One was, I feel like the PPP program, so the Paycheck Protection, I actually would be interested if folks wanted to put in the chat if their business, if they know if their business has applied for the PPP. I feel like that was a real policy failure. At the end of the day, sure, it has injected, a lot of money into the economy, but it was just so badly done. And if you think about it, this issue of paying companies to keep employing their workers doesn't work. That formula, which was they would forgive the loan if 70-something% went to payroll, and then they could use the remaining amount to go for other costs. That math does not work for most of the companies that have been deeply impacted. And there's a couple of things going on. One is fixed costs. That's not helping. I mean, companies can lay off people and then they're in the unemployment system, and then they can preserve their cash for fixed costs. And that's a big deal. We've done some surveys here in Boston of that. The other issue is, will businesses be able to bring back enough people? And I'm thinking, I mean, the restaurant industry is the classic example. If you're talking about having, first of all, most of them aren't even open, or they're open for takeout. Their employment numbers are dramatically dropped. They're not even going to get up to all of the requirements for the certain level of employment that they need to have. Yet they have, again, all these fixed costs and increased costs, because they all have to now provide PPE, not to be confused with PPP, but they also have to provide the protective equipment. They have to do substantially more cleaning. And so they have all these increased costs. So the math just doesn't work out for these companies. And so we've seen a lot of what I would call, as we know, larger companies, they're just sort of taking this as just another source of cash, and that's fine for them. And then, of course, we did see 149 publicly traded companies take this money, which was meant for small businesses, because there was a loophole because of the number of employees they have. The whole point was it was supposed to be an alternative form of cash. And then the other thing about the PPP was using the mechanism of banks. And I'm sure you've looked in, from your research, that since 2008, the largest banks have all exited the small business market. Small businesses don't usually get their banking. They're not getting their banking services from large banks. They're getting it from community lenders. And we did a survey where no small businesses in the Boston, the South End area, there were like 100 of them. None of them got this PPP funding from banks that they didn't already have an existing relationship with. So
that is very true, actually. Some of our students recently worked with Northern Bank and Trust Company here, which is again one of the smaller banks in Burlington, Reading actually, close to here. And they have been handling a ton of PPP applications from the local area, essentially.
Yeah, and particularly in the second wave. The first wave, it was big banks giving out large checks. I mean, the average size check was hundreds of thousands of dollars. And if you look at your average business, small business, the amount of money they were able to apply for was, in the tens of thousands of dollars. So yeah, so I think that policy, so as a result, there's going to be a huge ripple effect because it's too little, too late for so many small businesses. And these are the small businesses that make communities, what they are. They're the smaller shops that we enjoy going to. And of course, the restaurant industry, it's just devastating. Some of the best things in life are going to a restaurant you like and maybe sitting at their sitting at the bar, sitting outside and enjoying it. It's just going to be devastating still. It's still happening. So.
Right. And, you mentioned two things, which I think are critical. And, as luck would have it, and I swear this is not rehearsed, by the way, between Barbara and me, I found some data on it from the census thing. So one of it, which you brought up, is the cash that at hand, which I think is critical, as you mentioned, in terms of how small businesses can survive. So, and this is current again up to May 23rd. And the interesting finding, and this is a survey, this is called the Small Business Pulse.
I've got to
survey.
put my glasses on to check this one out, right?
So it's called the Small Business Pulse survey that is conducted by the U.S. Census Bureau. The interesting thing of the U.S. Census Bureau is that they have data on almost every single registered business in the United States, their microdata. So they have a very good pulse. And this is amazing that they have been able to do this at almost real time. If you look at this number, the highlight of this is that cash on hand for small businesses of greater than 3 months is 25% of businesses owned. So which basically means that 75% of small businesses are essentially, if by August we do not get back to where we were, 75% of small businesses are essentially either going to close or going to be in very serious trouble. And you can also see this data in these graphs. And let me just quickly explain what this is. So this is a graph that is sourced from something called foot traffic data. Essentially, it's a representative sample of data collected from consumers across the United States, representative sample across the United States, who provide their geolocation through their cell phones to different providers. It's anonymized and then collected and aggregated. And this is the foot traffic as of May 31st into bars. So if you look at restaurant industries, and the blue line is this year, the orange line on top is what it was same time last year. And you can see that, this is a normalized data. The difference between these two is huge. So it's a major effect. And the same thing kind of, if instead of bars, if you look at coffee shops, quick service restaurants, which are the small ones that serve customers, a lot of these, which are minority owned in many, many cases, have a huge impact. And this is going to be devastating, as Barbara was saying.
I think the real challenge is, for small businesses where they have fixed costs. So, and it's such a difference. So for example, small, it doesn't have to just be retail, like restaurants and bars and things like that. But you think about small food manufacturers, where they have a pretty small footprint, but so as a result, now they're supposed to go back to business with their staff, and they have to keep social distancing. They've had to reconfigure how they do all of their work. They have so much less flexibility built into their business model. Just because, hey, if you're manufacturing food, you can't just all of a sudden decide to like move to a bigger warehouse or something like that. That just isn't practical. And it's such a contrast to what I'm seeing in the high growth companies, where, you know, our mantra, of course, I think all businesses' mantras is cash is king. But our mantra is like, you know, do you have money to get, you know, do you have your run rate to get to the end of 2021? That's been our goal in, you know, all the conversations that I've had with all my portfolio companies. And it's just, you could just see how much more nimble they can be, because even the companies that manufacture, because they're high growth, they sort of have, you know, they have much more flexibility built into their system, you know, than other kinds of companies. So I just sort of go back. One other thing I wanted to go back to, like with the other policy. So the public policy coming out just is not, it's not going to work, or it's not working. But the other program that you mentioned, which was the Main Street Lending Program, and this is also a misnomer, because the Wall Street Journal did a really good, quick, easy write-up about it. And basically, you have to have about $1 million in EBITDA, which, it's funny, I know I can be on this webinar and actually use that, not have to explain what that is. And so you have to have about $1 million in that before you could even apply, because the minimum amount is like that you can apply for is $1 million loan, and it has to be a multiple of your profit. So you actually also have to be profitable. So it's like all of this stuff, and it's a great deal. And so I see there's a lot of liquidity that's going to go into corporate America, but it's definitely not going to the companies that have the most pain. And one thing, just talking about disparities too, that I know we talked about, which was, you know, in the PPP program, you know, it was these bigger banks basically facilitating these loans that turn into grants, facilitating them for their largest clients. And that was just not where communities of color were banking. But the other interesting thing was we surveyed when we worked with a lot of Latinx business owners, and a lot of them were very distrustful of this concept of borrow and then it'll be forgiven. They didn't believe that it would actually happen. And I know that we're still, a lot of businesses are concerned that they're not going to get the forgiveness. So they didn't even apply in the first round because they didn't trust that this was going to happen. So there were lots of reasons for the disparities that happened in you know, who got funding in that round.
And you know, you can see it, the heterogeneity of it in that you know, application data that we saw earlier. There is huge heterogeneity across the different cities on that. On going back to your earlier comment about the Main Street loan programs, those are bigger loans, and you know, there are 3 different programs there, all of which are sort of targeted towards medium-sized companies, and and those loans are not to be forgiven. Those are mostly
it's a great source of liquidity for, you know, it's a great source of capital for those companies. But by calling it the Main Street Lending Program, I don't have a problem with the program as it is, that like, this is what it's doing, because it is a good way to get capital out there. But to call it a Main Street Lending Program is just bullshit. You know, it's just, that's not who these companies are. They're not on anyone's main street. So
they're
yeah,
much
I think
bigger companies, absolutely.
They're much bigger
companies, much bigger companies.
And a lot of them need the look. I mean, they actually absolutely need this money. So yeah.
Definitely they're going to be benefiting, but like, you know, to just put some numbers into perspective here, if you are really thinking about small businesses, 80% of these small businesses have 20 or fewer employees.
Right.
The SBA definition of a small business mostly is around 500 or fewer employees. And the Main Street loan program is targeted towards businesses that are 15,000 or less employees.
Yeah.
So it's, even if you think about from the perspective of the SBA definition, it is like multitudes more than what it is. So I agree with you. There is a little bit of a misnomer there in the sense that what the idea that Main Street conveys to you in the local coffee shop or the local small general merchandise store or other business, a lot of which again is minority owned, is not what this program is targeted towards. So
No. And also the nature of it, which was first come, first serve. And of course you had the large applications going through first and taking most of the money. That doesn't favor small businesses for whom, filling out the application was daunting. I will say I was very pleased with how some of the payroll providers like Gusto, and I presume ADP did the same thing, that they had ready click buttons. Like, here, you want to know how to calculate what you're eligible for? Click this button, because they had your data and they could do it for you. It just showed like how, technology companies can just innovate on a dime to do that. And so that was pretty
That's
impressive.
Amazing. That's very nice.
And now they're helping too with like the follow-up and making sure that, so that companies can comply. Yeah.
Right. So, changing gears a little bit towards more towards angel investing and venture capital investing and that world. Over the last several years, some of the issues there has been the huge soaring private valuations in that market. What is your opinion about how COVID-19 might impact that issue in the private markets?
Well, experienced VCs were all like instantly like, okay, this is a downturn. Okay, there are going to be some haircuts, and demanding it at across the board, which, I think in some cases, so a deal that you might have turned down because it was too pricey in December, if they still hadn't closed their fundraising, they probably made some adjustments when you wanted to look at it in March and April. So it's always good to take a little bit of the froth out of the market. I also feel as though what we were seeing now that we're focused sort of on this crisis, we've taken our eye off one of the other big stories of the past like 12 months, which was just the implosion of a lot of these heavily funded venture-backed companies, whether it's WeWork. Uber is just it's a rolling fireball, and so showing that there is a limit to the appetite of private equity to fund some of these things. So, but now we're in this sort of new era where it's the other thing too with most investors, the first thing we did was take a quick look at what our existing portfolio is. And most, especially since I invest pretty early, seed A, I do have some B's and C's, but it's because I invested at the seed. They were looking to see like, what do the companies need in my portfolio? Like what do those companies need? And so, and now that's work is over, like, finding out all of the entrepreneurs, sort of sent out there, this is how we're managing during this time. And now we're looking at whether companies need to pivot, what are new opportunities. And so because the mantra is, it's not just that because the prices have come down, but it's also that, during times of crisis, just like it was in 2008, you make great deals and companies focus on really more important or more valuable innovations. So you're going to see a lot of, just a lot of companies won't be able to get capital because what they're working on is just not, it's not having as big an impact. It's not going to be as impactful.
Right. So in some sense, what you're saying is that the threshold of investing might change on the quality front, the threshold on the quality front. And also many of these, the valuations would be more attractive to investors than what it was before. And we already see some evidence of that actually. So in the first quarter, ending this year, and I'm just going to show one quick last slide. First quarter ending this year, we have right. So this is the average investment in seed round by angel investors, and so this is from quarter 4 2019 to end of quarter 1. So that's end of March, where the impact of COVID-19 wasn't really hadn't really still hit hard, but you could already see that there was a dip that was coming in at that time. And if anything, we don't have I don't have the latest numbers, but at the end of the second quarter, that might probably be intensified a little bit more. The other issue in this market, as you mentioned, obviously, is the recovery part, or thinking about the recovery part when you're investing in a down market. And historically, I think every single time we have been in a pandemic situation, or we have been in a global recession, the recovery has been, or actually, in a pandemic situation, historically, the recovery has been solid over the next decade or so, in terms of higher growth in wage rates, growth in employment. So hopefully there's a lot to look forward to as well as we get out of this, though our focus might be on different industries than what it was prior to COVID-19 coming in.
Yeah, one of the things I talk a lot about is what we don't even know yet, how fundamentally consumer behaviors are going to change as a result of this. We're seeing the obvious things. You can't go to a restaurant. You don't go to a restaurant. But are you going to want to go to a restaurant? And what kind of, how is that going to change? Housing is going to be hugely disrupted, because first of all, we saw a lot of people fleeing large cities when they had, perhaps smaller apartments, that they realized they were not going to survive quarantine isolation in their apartment with, their other roommate or however their life was structured. So we saw a lot of that. I think we're going to continue to see a lot of disruptions. And then of course, the acceleration of things like, telemedicine. The technology has been there for a long time. Mm-hmm. And now this acceleration of the adoption, mm-hmm. I think in working from home, all those jobs that people said they couldn't do from home, guess what? You can do pretty much almost every job, or lots of things you can do in a totally different way. But just that disruption in like what consumers are going to want, it hasn't shaken out yet. We still don't know. And I think that makes it interesting.
Shall we open up for some questions, perhaps, Shane, at this point, and then continue our discussion?
Sure. And just a reminder to folks, if you have a question, please ask it. The Q&A function should work. If not, go for the chat. We're following that. The first question is, something you said earlier, Barbara. You said in your portfolio companies, they need cash to run until the end of 2021. Does this mean not to expect VC or angels to fund startups until then? And what does the startup scene look like in the next 1 to 2 years in your mind?
My crystal ball. We want them to have cash because it's not so much that you need to have the cash to get to the end of 2021 and then you raise. It's that you do not have that pressure that you have to raise, because raising money when you're desperate for cash is just a recipe for disaster. So I would say the big changes right now from an investor perspective, because there were a lot of questions in that, like that was like a giant sandwich of questions that you just asked. But you know, I'm definitely seeing individual investors exiting. Like they're just not, you know, they've got their own personal stuff to deal with. Because I know there's a chat there, in also advice for founders. I would really steer clear of individual investors for the most part, unless you know they're actively writing checks. You know, the whole point of a fund, VC funds, institutional investors, you don't make money by having your money on the sidelines. You have to deploy your money to make money. And so they are actively looking for deals. And we're looking to, you know, make sure that what we're investing in is relevant. We're not, you know, going to invest in things that are what I call, like, I don't know if folks remember, like the Y2K problem. You know, there was this mad rush for companies to solve the fact that we were going to need 4 digits in our years in our computer code. And that was a real fad. I mean, that's not lasting. So some of the, you know, there are immediate needs around our pandemic. But, you know, what are the things that are actually going to be lasting effects? So so what other question did I not answer in all of those questions you asked me?
So
I think you answered it, but do you have a sense of the startup scene in the next 1, 2, 3 years? That's your crystal ball, but I think you answered it, but do you have anything to add?
Yeah, but it's going to be really interesting to see how companies, like the startup scene will no longer be a scene. But we're still doing things like a lot of conferences and things that used to be in person are now, you know, remotely. So it's going to be different connecting. Like, how do we connect amongst? So I'm doing normally I go to there's a life science conference that I go to for a couple of days, and I literally like meet a new company every half hour and sit down and talk to them. And now we're doing it virtually, and so we'll see how well that goes. You know, I've done a lot of my investing virtually. I do a lot of my investor meetings via Zoom. Yeah, and then just depending on how much capital people want to deploy, institutions, like I said, they have to deploy the capital or they don't make returns. And they all know that, you know, the vintage, you know, 2008 vintage investments were some of the best.
Mm-hmm. Absolutely. And, you know, the valuations of companies might take a hit for no reason, you know, no dearth of effort of their own, which is because just the whole economy is going down.
Yeah, I'm a little concerned about that for certain demographics of founders, because we know that you know, particularly for women and women of color, you know, the valuations are already pressured downward.
Right.
And, you know, whereas I think there was a lot of froth in the market for a lot of sort of, especially these overpriced late stage,
Right.
you know, things that I love to rail against because I just don't think they're useful innovations. But yeah, so it's not fair if we just sort of have that haircut approach where everything gets lopped off by 25%. So I'm actually working on a deal right now where I'm trying, because I want to make, you know, support the entrepreneur. I want to make sure that the valuation is as high as it makes sense to be. I'm not going to be taking advantage of like this economy to do this, to push it down.
Right. I mean, you know, your earlier comment on having cash in hand, I think is all the more reason in periods where, you know, you can avoid raising a down round in a lower valuation period if you have that cash in hand. So, yeah. So maybe, you know, in your own portfolio of companies, has any of your companies has received any of the PPP funding or any of the other loans?
Sure. Since they're all startups and none of them are profitable, none of them are getting that loan. But some of them are going to apply to that disaster, the EIDL, whatever that is. Yeah, that one. That another alphabet soup. But yeah, most of them have applied and gotten the PPP. They were all pretty on it. It was really interesting. Silicon Valley banks, just to sort of name shame maybe, there were a lot of like, I think Silicon Valley Bank, I mean, they sent out a note saying they weren't even going to participate. And here it is, you had all of these companies that like, oh, they banked with them and you're like, wait, you're not participating? They changed their tune after a while, but a lot of companies were scrambling. And it just caused like so much stress, for, and especially this is for entrepreneurs who are used to fundraising. So they're used to, raising money, and that now when they actually look at like, how much time and stress did it cost me to get this funding? And now I'm concerned that I might not get it totally forgiven.
Mm-hmm.
Yeah.
Barbara,
but I've had loads of my, well, I was gonna say, and plenty of my companies have laid people off, lots of people off, canceled leases, canceled deals, done all kinds of, and that's one of the interesting things to see. High growth companies, just they operate at such a faster rate than a lot of our local small businesses, even though they're both small businesses, but it's just that speed of adaptation. It's been pretty interesting to watch.
Mm-hmm.
Barbara, you saw this, alluded to it earlier, but we have two questions around, what are the opportunities here to found or start a new company? Brad here says, what advice do you have for founders who are seeking seed capital in this environment? And then another person just is curious, do you think it'd be much harder to kind of go out and talk to prospects, investors, clients through an online environment versus, going into an office or a coffee shop, whatever, to make the pitch?
I think that it is, so I mean, maybe I'm a little different than other people anyway, but like, I prefer to meet online because with I literally only have to commit half an hour. I don't have to commit to driving somewhere and meeting and waiting and whatever. And it's awkward to have like a really short in-person meeting. So I think it'll work well. But again, as I said, individual investors are not where it's going to be right now. They're going to follow other more maybe, angel groups, but even then angel groups, that's basically a collection of individuals. So I'd say small micro VC funds, you'll have individuals following them. And so that's where I would focus on. And I think, you should be able to get in front of them because there's less friction because they can't meet you in person. But you have to make sure that you have, like, have you fully taken into account what this new world is going to be like as best as you possibly can? Are you working on something that's really important? Has it become more important? Because I can tell you there's entire categories of things that I'm really not interested in. I'm not really interested in a lot of, consumer, direct to consumer, because I see the disruption in brands is really huge. I'm also not a huge consumer investor. I do prefer, B2B type things. So yeah, I mean, it's not impossible. I mean, I'm investing. I made, let's see, since I've been quarantined since March 15th, I'm trying to think how many new investments I've made. I definitely made one new investment and I'm pretty close to making a second one. And that's brand new to me. And then of course I've made some follow-on investments with some of my existing companies. So investors, they're definitely out there. You just have to know, like, do you really fit what they're looking for?
So Barbara, picking up on something that you said, that you prefer B2B kind of plays rather than B2C. I mean, that is almost generalizable to the East Coast, I would think, right? Or definitely to Boston, as opposed to San Francisco, where a lot more B2C play happening.
They say that, but I find that that's not true. I find that there's, I mean, you think about like, you have like Wayfair, you've had a lot of direct to consumer B2C companies come out of the East Coast. So
yeah, Wayfair is one big success. Toast is probably, Toast is still B2B.
No, that's B2B. That's B2B.
Toast is B2B.
But yeah, I think, yeah. But I actually feel like some of the monster B2Bs are from the West Coast as well. So I just, maybe it's just it's a magnitude.
I'm going to ask two final questions, and then I think we're going to turn it over to our closing remarks. Barbara, just to go on this question as well, in light of all that's going on and whatnot, I'm also curious from your lens, this new online environment or just how things have changed even in the VC world. Do you see the options for more equity now with things going online, or just kind of taking away some of the other factors that may have led to, discrimination, a lack of financing, and, group, companies led by or founded by people of color or women? I'm just curious your lens on that. That's question one. Question two is different, but I think it's best to ask it now. Are CDFIs, or community development financial institutions and nonprofits, providing interest-free loans meeting the needs of small businesses? So I'll let you go with that, and Debarshi jump in as well before we close up.
Yeah, I mean, so on that last one, CDFIs weren't even included in as being one of the providers of PPP. So they were sort of shut out. So they do, I mean, that's what CDFIs do. They do provide, very low interest rates for lending. So that, I mean, that's what they do. And so they're continuing to do it. Most people don't understand that the CDFIs are a very safe source of money and in both directions. So I'm an investor in a company called C-Note, which provides additional capital to CDFIs because they're always looking for alternative sources of capital so that they can lend out. And C-Note has been tracking the profitability and the safety of CDFIs for a long time. So it's great. Nonprofits, I see foundations. Foundations are definitely like in the game, and they know it. They know they have to lean in. You know, the ones that are like, they understand this is their mission in times of crisis, they need to lean in. They're still, whether they're not necessarily, I don't know if they're necessarily supporting directly. They're not supporting directly businesses, but they're providing support services. That's definitely true. And then of course you also have a lot of nonprofits who are in a lot of trouble because of, the work that they're doing and the funding that's been disrupted, particularly those that were very focused on fundraising via events, which, by the way, I would love to have the end of like big fundraising events, because I never want to go. I never go. I think it's not the right way to be raising money. I think so. But that's a whole separate thing. And what was the first question? See, this
First
probably
question was more on the equity part. Again, has any of this, you spoke about a little bit, and this could be a future opportunity, but again, this changing way of how we're raising money, how we're pitching people, are there equity opportunities here that weren't before?
I don't know. I've been doing this for a long time, and I don't know. I think people are more aware of it, and people are more comfortable calling out investors who, just are not investing in, they're investing in monoculture teams. I tend to follow a Moneyball quantitative approach, and I know that diverse teams outperform. So, that's sort of my philosophy, and that's why I've always supported diverse teams. I'd like to say that I'm optimistic. I am seeing institutions, so whether it's a strategic investor, so like a corporate VCs have always had better records in being more equitable in their investing. And now you're seeing family offices, foundations, and progressive high net worth individuals getting more into the game earlier. Because the problem is with big foundations, they tend to want to invest at a later stage, but you can't harvest something that was never planted. So, that's been one of the issues. And so now they're more willing to come in at earlier stages. But I just see that, angel investing in particular, because it's a personal decision by individual investors, I see that the bias is going to continue. I just see it. I see it every day. So I'm going to end on a downer there. I'm sorry.
Yeah, I'm sorry, but unfortunately, I think I also agree with you, because this is, if anything, so for example, corporate VCs are getting severely curtailed in this. It's one of the, as when you are in a recession, that is one area of sort of close to discretionary spending that you can easily cut off, and they do. Going back to the earlier issue on the CDFIs and the foundation. So I just want to mention the Kauffman Foundation, which I think has been doing a lot of work focused towards small businesses during this time. In fact, in also supporting providing grants and funds to many. They are localized.
Well, Kauffman supports entrepreneurship, so they tend to be supporting the ecosystem and not companies directly.
Right, but they are,
and they don't have a great track record on diversity, for the record.
No, but I unfortunately do not know enough on that, but they have been supporting the CDFIs actually. That's one of the things that came out. They've started a new fund, two funds that I am aware of, one in Birmingham and one in Kansas City itself, that they have started during the COVID-19.
CDFIs are a weird vehicle, because I get the impression that no two are the same. That's been the interesting thing with C-Note, is that because they are connecting with the CDFIs and collecting data, they're actually able to sort of understand that ecosystem pretty well. And so that's been really interesting for me to hear, to learn more about that, because it is a weird sort of system.
All right. Well, I'm sorry to stop conversation there, but thank you to Barbara for joining us today. Thank you to Debarshi for joining us today, and to all of you, regardless of where you are. I think we had a good mix of alumni, faculty, staff, maybe some other friends or parents of the university. Really grateful to have you join us today. It's been a lot of interesting fun to have all these events that we've had online these last 3 months. So this was a nice addition to the suite of programming we can provide at Brandeis International Business School. To that point, our next event that we're involved with at the business school is next Thursday, June 11th at 7 p.m. Eastern, on the business of climate change, featuring Ben Gomez-Caceres and a couple of distinguished alumni of the business school, and Brandeis undergrads, as well as Brandeis International Business School. So keep an eye out for that in case you haven't heard about it. It should be a really great event. I'm going to close and pass it on to an alumna of Brandeis to talk about the Brandeis Women's Network. But thank you all again for joining, and Tali Potter is here to close things up. Tali?
Great. Thank you, Shane. Thank you for our wonderful speakers and everyone who joined us on behalf of the International Business School and the Brandeis Women's Network. And thank you to our sponsor, the Rosenberg Institute of Global Finance at the International Business School. As Shane noted, I'm Tali Potter, and I'm one of the co-founders of the Brandeis Women's Network that was founded about a year ago. It's a forum for women who are Brandeis alumni to come together and leverage the dynamic Brandeis community for networking and various social connections. We've held in-person, prior to COVID, we've held in-person events primarily in New York, but now we've transitioned online to Zoom events. We're holding professionally oriented events like a LinkedIn personal branding event, what's coming up this coming Monday. As well as social events, cooking classes, physical wellness classes, even a book club. So look for us on Facebook. It's Brandeis Women, and join the over 700 Brandeis alumni women who are already a part of our little group. And thank you for everyone. Please be on the lookout for many other events from the Brandeis Alumni Association partners. And whatever time zone you're in, be well and take care.
Thanks for inviting me.
Thank you, Barbara. Thanks, everyone.
Bye,
everyone.
Bye.